Welcome back to the session on Index. Today we are continuing with financial instruments and we are discussing about impairment of financial assets. In the last session, we discussed briefly about the impairment of financial assets, which was through expected credit loss model. And we also understood as to why this model has come in, what was the reason for this model to come in now. We also briefly understood how this model would take care of the requirements of impairment, which is very commonly known as provisioning requirement. Correct? Yeah. So now we'll get into the details of this model and we'll also understand how to apply this model or how to apply the principles of the impairment in respect of various financial assets. Yeah. All right. So I would suggest if all of you can just go to the study material, please. Here, go to study material, section number 3.10, page number 12.95. Page 12.95, section number 3.10. This is about impairment of financial assets. Yeah, all right. Okay. So now we'll get into the technical terms which are involved in the financial instruments. And in respect of those technical terms, let us quickly understand the scope of this impairment. So when is this expected credit loss model will be used? So this will be used on the financial assets, which are measured at amortized cost, fair value through OCI, which are lease receivables, a contract asset, or a loan commitment contract. You remember financial guarantee contract? We briefly touched upon that. We didn't get into too much details around it. This is another area that we have to cover. And this is something which gets recognized in the in the financial statements, unlike what we do in case of Indian GAAP. So this is something which will also get covered under this ECL model for the purposes of provisioning requirements. Okay, yeah. Now, whenever we look into impairment, there are a couple of things we are required to check, as we discussed last time around. One, the time value of money which is lost. And second, the default or the risk of default, for which we need to check the probability of default as to what is the probability that the customer or the party or the receivable will be defaulted. And this default may be partial or may be full. So we are just talking in the context of the amount which will be defaulted. Now for this purpose, there's a concept which we need to understand that is known as credit loss allowance. So what is this credit loss? Credit loss is again the same point which is around the receivables. So for every customer, what do we do? For every customer, we start to understand what's the credit risk of that customer. And this credit risk of customer will keep increasing. So we can just say that this can be divided into various stages. At the first stage, what will happen? At the first stage, the receivable will be clean. At the first stage, the receivable will be clean. We don't see any problem attached to that receivable. So we can say that this is stage one. In case of stage one, we don't see any problem attached to the receivable. Receivable is only an example. We are talking in the context of financial assets which are scoped in for this impairment. Now under stage one, we are saying that the receivables are clean, means there is no default. There is no default so far. The payments have also been made on time. Payments are on time. Okay. Now in this case, because there is no default, payments are on time. That's why whenever we will recognize interest on this, so there's a concept of recognition of interest on this. Let's understand how can that interest be recognized. Say this receivable is a loan given to a party. Okay. And on this loan, interest will apply at the rate 11% per annum. Let's suppose the amount of this loan is 1000 rupees. Correct? So what's the interest amount on this? 1000 into 11%, 110. Now the interest which we will recognize in this stage 1 will be on this amount, 1000 rupees. That means we will recognize interest amount on the gross value, on the gross amount. And what's the gross amount? This is the gross amount. Fine. Yeah. So how do we recognize it? So interest comes out to be 110. And you may be thinking about the provisioning right now. That's what will happen to the provision. We'll come to that. Now on this stage, what do we say in terms of the credit risk which is attached to the customer or which is attached to the receiver? That the credit risk is low. At this stage, credit risk is low. Credit risk has not increased. Why? Because of all of these factors. And that is why entity will be recognizing interest income on this. Because the principal is getting recovered, that's why interest accrual will also keep happening. Yeah. Now, let's move on to stage number 2. So say we move on to next stage. In this stage, that means in this stage, we see some defaults in terms of payment. So now there are defaults. We can see defaults are being made by the customer or by the party. So that means the payments are getting delayed. Defaults are being made, means some of the payments have also not been made. What does it indicate? This indicates that the receivable is becoming worse. We can now see problems in terms of recoverability of our amount. And that is where we say that the credit risk attached to this customer or to this party or maybe to this portfolio is increasing. What do we say? Credit risk which is attached to this portfolio is increasing. Yeah. But still, we are not saying that the money will not be collected. No, we are not saying that the money will not be collected. Money will be collected. But yes, the way the money is getting collected and the way the expectations of collections have now been built up or maybe revised, that shows problems. That shows problems. Now we need to do something about it. Correct? So there's now a sense that something needs to be done around these receivables, which are into stage number 2. Okay. So we are saying now when we move from stage 1 to stage 2, we see credit risk has increased. Okay. But still, because collections are being made, even with certain defaults or even with certain delays, still the interest income will continue to be recognized on the gross amount. What's the gross amount? 1000. Okay. And I'll come to this principle also. What's this gross amount? And why I'm just repeatedly saying that it's the gross amount. Why the gross amount should not really be the gross amount. Yeah. Now, let's move on to next stage. Now, stage number 3, we can say, is the worst stage, wherein the party is significantly defaulting in the payments. There is very less likelihood that the monies will be recovered. Means the credit risk attached to this portfolio has increased significantly. And that is where the problems are also considered to be significantly higher as compared to stage number 1 and 2. Yeah, correct. Now, in this case, when we say that the problems have increased significantly, there are defaults, and the defaults are also significant. So there are significant defaults. Money is not getting collected. A lot of problems are being faced. And the entity is also not sure whether entire money will be collected or not. Yeah. Now in this stage, a question will arise whether we should recognize interest income or not. And if we recognize interest income, how do we recognize it? And the same thing was considered by us in stage number 1 and 2 also. But in stage number 3, it's all the more important for us to understand about it. Correct? Now, in stage number 3, we will see a provision of this amount, 1000. Means some amount which is not expected to be recovered will have to be provided. So let's suppose out of 1000, provision has been made for, say, 500. Provision has been made for 500 in this stage. Okay. Now a question arises that should this provision be made only in stage 3, or do we need to create a provision in stage 2 and stage 1 also? So the answer is that provision will also be made in stage number 2. It could be a provision. It could be a provision which is lower than what we see in case of stage number 2. But the provision will be made over here also. Yeah, provision will be made over here also. Correct? And similarly, the provision will also be made in stage number 1, and we'll understand how that provision will be made in stage number 1. For the time being, you can say that provision will also be made in stage number 1. Let's suppose over here it's only 100. I'm not writing it, it's only 100. Now, as regards interest, we considered recognition of interest on the gross amount. What was the gross amount? If we look at this portfolio, the gross amount is 1000 rupees. This was the gross amount over here also. Correct? And this is the gross amount. Because the gross amount will not change. The principal will not change. Principal will remain same. Yes? So now, standard says, when you are in stage number 1 and 2, it's okay to recognize interest on the gross amount. Why? Because we are not expecting this 1000 that it will not be recovered. The expectation in stage number 1 and 2 is still that 1000 will be recovered. But stage number 3 is the worst stage. The credit risk of the customer, of the party, has increased significantly, and that's why if you are in stage number 3, then the interest amount should not be recognized on the gross amount. Instead, it should be recognized on the net amount. So what will be the net amount? This is the net amount and this is the gross amount. Yeah, what's the net amount? Net amount means principal less provision. That's the net amount. On the net amount, interest should be recognized and not on the gross amount. Clear on this? Yeah, clear on this point? Any questions in case you have on this? Now, this is something which is very, very subjective. One immediate question which comes to our mind on the basis of this discussion is that, sir, how do we assess whether an asset will fall under stage 1, stage 2, or stage 3? What's the parameter for us to assess this? Or what's the guidance? See, this is very, very subjective. So there's no criteria, there's no rule which I can just tell you on the basis of which we can just put any asset into stage 1, 2, or 3. As I told you, this is judgmental. So that's why every time judgment will have to be applied for us to assess as to when this asset will fall into any of these stages. All right, clear? Clear on this? Yeah. So what we can now do is we can also go to the presentation and just try to see some points around it. Okay, something which we have discussed just now. This is again available on the presentation, which shows these 3 stages and which also shows as to how the credit risk has been increasing from stage 1 to stage 2 or stage 3, and what is it that it has been doing in terms of creation of provision when we move from one stage to another stage, and what is it that we are required to do in terms of recognition of interest income in respect of that portfolio or in respect of those assets. Correct? Yeah. Okay. Now, all of these points we have discussed, which you can also see on the screen, except for recognition of provision. Because that is another question. That's how do we create provision? What's the basis? What's the percentage? How do we assess it? Is it judgmental? Can we just take any amount on our own for the purposes of creating a provision? Or is there any criteria which needs to be assessed, which needs to be considered, using which provision will be required to be created? Yeah. For this, I would first of all suggest all of you to come back to a flow chart on the study material page number 12.95. All of you, if you can go to study material page number 12.95, there's a flow chart which is available. And this flow chart is similar to what you can see on the screen right now. Okay, this flow chart is similar to what you can see on the screen right now. Both the flow charts are having the same flow, though they are presented differently. So now we will talk about this flow chart. Yeah, but I would just request all of you to look through this flow chart from the study material instead of this presentation right now, because that will be helpful for all of you at this point of time. Yeah, so let's move on to the study material, please. So the first step that we need to check, is financial asset a trade receivable, lease receivable, or a contract asset? If yes, measure the lifetime expected credit losses. Now it's a new term which has come in. Lifetime. Now, what do we mean by lifetime? Is something we don't know. So we'll have to understand that. Huh? Okay. Then the flowchart says, if the financial asset is not a trade receivable, not a lease receivable, or not a contract asset, then what do we need to check? We need to check, has the credit risk increased significantly for the financial asset? Has the credit risk increased significantly? When is that increasing? When we move from stage 1 to stage 2 and from stage 2 to stage 3. Because this is the flow. If we say yes, it has increased, there again it says apply lifetime ECL. If no, if it says it's not increased, then it says apply 12-month expected credit losses. Yeah, then it says apply 12 months expected credit losses. Now this is something which is very interesting. So it says apply 12 months expected credit losses model over here, something which the flowchart is telling us. And in case it increases, then instead of 12 months, apply lifetime. Over here also, because once we move from stage 1 to stage 2, then stage 3 is any case after the stage 1. So that means over here again, it is requiring us to apply lifetime ECL. Yeah. So now it will be important for us to understand these terms, because only then we'll be able to make out as to how to make the provision. And this also indicates that the provision will also be required to be made in stage number 1, something which we discussed. But as we discussed that the provision will keep increasing as we move from stage 1 to stage 2 to stage 3 is subjective. And how do we compute it? Once again, we'll have to understand using these terms. Before that, I'll answer the query of Kaustav. Kaustav is saying, sir, if the expectation of recovery is there in stage 2, then why make a provision? Is it only because the standard says so? I think, Kaustav, I'll just further extend your question before answering it. You are saying why we are creating a provision in stage 2. I'm saying even in stage 1, we are creating a provision. For me to answer this question of yours is very, very easy. But the question which I have extended is something which is important for you to understand. So first of all, I'll answer your question. See, in stage number 2, we can see that the party has started defaulting. The defaults are being made. The credit risk is visibly increasing. Can we see this? Credit risk, which is attached to the party, has increased. Yeah, as we are moving from stage 1 to stage 2 to stage 3. So that's why it becomes important to create a provision in stage number 2 and definitely in stage number 3. I think your question would have been more sort of valid if we put this in scenario of stage number 1, wherein I am saying that there is no default right now. Payments are also being made on time. Then why we are creating a provision in stage number 1? And as I told you, I'm just not writing it, but the provision is made over here also. Let me just write it. Maybe there's a confusion. Okay. To clarify all of you, So over here also provision is made. Let's suppose the provision amount is lower. Yeah. Correct? Yeah. Cost of now this looks sort of more extensive. Okay, now let's try to understand this. And this can also be understood with the help of our understanding of 12-month and lifetime. See, as we discussed in the last session, now we will not wait for the loss to be incurred and then make a recognition in the books. No. This is something which we used to do earlier. That till the time loss is not incurred, it will not be recognized. Now we need to build an expectation. If we see a loss may arise in future, then today itself, on the basis of that expectation, we need to create a provision. Okay. And this is something which we do on the basis of historical pattern. So let me just write these points also. So there are a couple of things you will consider for this. I need some space to write this. So what do I clear? So let me just write it over here. So there are a couple of things we will consider for making a provision. Historical pattern. Now, what is this historical pattern? Let's suppose you are selling some goods to a party, and this is something you have been doing for the last 5 years. And you know that every time this party makes a payment, it is after the due date. Okay. Every time, historically, this is something which you have seen. You have checked the trend and you know that this party generally pays after the due date. Number one, we are not saying on the due date or before the due date, after the due date. Number one. Number two, we also see a trend. We also see a trend of defaults being made by this party. Means every year, out of the receivable amount, 2 to 3% is defaulted by them. Means they don't make the payment, which could be for various reasons, but this is something which we have seen. Now, in this scenario, what do we do? In this scenario, when we are making a sales to this customer, should we wait for this scenario to arise and then create a provision? Which means, should we wait for stage 2 in respect of this customer to make a provision? Or do you believe, with this understanding, that we should create the provision for this customer immediately? Means when we are in stage number 1. I would just wait for inputs from all of you, and that will be helpful. Yeah. So what do you think? When should the provision be made for this customer? Quickly, huh? What do you think? When should the provision be made for this customer? Guru Raja, I think your question will automatically get answered with this example that we have been discussing. Yeah. Yes, quickly. I'm waiting for responses. Huh? What do you think about the requirement to create a provision for the customer I have just discussed with you? Quickly, please. Chavi is saying, so the provision should be immediate. We should not wait, because in the past we've seen a trend which is good enough for us to create a provision, and we should not wait for the loss to be incurred. So that means Chavi is of the view that we should create the provision in stage 1 itself, and we should not wait for stage 2 to arise. Yeah, is that correct? Okay, what about others? Same is the response from Vaibhavi. Webavi is also saying that self provision should be made at first stage. We should not wait for the second stage. Correct? Yeah. Very good. What about others? Rohit is also saying the same thing, that yes, it should be created in stage number 1. Now, if you are clear about it, and if all of you have the same view that stage 1 is the stage when the provision should be created, now a question arises that how should this provision be created? So whether it should be created or not is something on which all of us are clear now, I'm hoping. Yeah. But the next question which will arise is, how should that provision be created? Means what will be the basis? Now for this, standard once again helps us. Standard says that the basis of creation of provision will be the historical pattern. We know that in the last 5 years, 2 to 3% has been the default percentage. So that means what will be the expectation? Expectation will be that in the current year or for the sale which is being made, again the default percentage will be in the range of 2 to 3%. Correct? This is called as creation of provision on the basis of historical pattern, and something which you would have also applied practically. The timing may be different, but you would have applied practically. And Kostab is also saying, yes, sir, this is correct. Provision should be made immediately. Now, other than this historical pattern, standard says that you will not only look at the history, you will not only look at the past records, you also need to be a forward-looking person. Means you also need to look at the future. So that means this creation of provision will have 2 aspects attached to it. Will have 2 aspects attached to it. One will be the historical pattern, means the past record. And second will also be the forward looking. That means we need to build the expectations. Build the expectations as to what is expected out of this party in terms of its behavior in the future. Because it may happen that in the past years, this customer was incurring losses. The financial position of this customer was not very good. That's why every time we saw defaults. But now the position of the customer has improved significantly. And that's why even though we have a past trend of 2 to 3% default, our expectation would be that this time around, customer will not be defaulting more than 1%. This is called as forward-looking outlook. So standard says that whenever we will create a provision, we need to look at both these aspects. Now, once again, I cannot give you a thumb rule that this will become a rule or this will become a checklist. As I told you, these are very, very subjective matters. Yeah. But one thing wherein the standard is clear and which is also a sort of rule is about the period of the expectations. Standard says that if you are in stage 1 or if you are talking about financial assets other than lease receivable, trade receivable, contract assets, something which we see on the flow chart. You can go back to the flow chart, please. Then the period you will consider, this period you will consider should be the next 12 months only. Means whatever expectations, etc., whatever factors you will consider for the future in respect of that party will be for the next 12 months only. That doesn't mean that we will consider the provision for the next 12 months only. No, the factors that we need to consider in respect of the party will be for next 12 months to decide about the provision. But in case you are moving from stage 1 to stage 2, then you will not limit your factors for the next 12 months. It will become lifetime. Means you'll go beyond 12 months. You'll have to consider all the factors which may be possible, which may be relevant for you to assess the amount of provision. And that's the difference between these two models. But we also need to be very, very clear as to when to apply this model at what stage. Okay, clear? All of you on this aspect? Yeah. Now, if you'll go to the standard, you will not see stage number 1, 2, and 3. Nowhere in the standard you will see the stages. As I told you, this is something which is subjective, and this is something which is based on the standard. For the purposes of our discussions, that this has been created. So that's why please don't try to find these stages in the standard. You will not see the stages. But yes, once you go through the standard, once you go through the literature, you will understand the relevance of these stages. You will also understand as to why these stages have been created for the purposes of our discussion. That doesn't mean that these stages are wrong. It just means that these stages are for simplicity's sake, for the purposes of our understanding of the concept. And that's why I'm telling you, there's once again no rule for us to decide when would a company be in stage 1, stage 2, or stage 3. It's highly subjective. Okay? Yeah. Now, there are certain factors which you should read on page number 12.97, which helps you to assess how would the credit risk increase in respect of a party. Yeah, you can just go through this part, just flip through this part for the purposes of your reference only. Okay, yeah. Now we can move on to a rebuttable presumption. So let's understand what is this presumption. Rebuttable presumption. Let's move on to this, please. This is on page number 12.98. Let's read through this. What does it say? Regardless of the way in which an entity assesses significant increases in credit risk. How will the credit risk increase? When you are moving in this direction. Okay. So it says regardless of the way an entity assesses these increases in the credit risk, there is a rebuttable presumption that the credit risk on a financial asset has increased significantly since initial recognition when the contractual payments are more than 30 days past due. Past due means overdue. So what's the rebuttable presumption? That if the payment is not made within next 30 days by the customer, by the party, then it will be presumed that the risk has increased significantly. Now let's try to relate to this practically. See, when you look at certain entities which are outside India, therein the customer behavior, the way they operate, there's a strict compliance of the terms and conditions which are attached with the purchase order, with the sales order, with the sales agreement, with the terms and conditions which are discussed, agreed between the parties. And therein, this term is easy to be applied practically. But in India, if you look at this term, practically, this will not be easy to be applied. And I'll tell you why. And I'm sure many of you who would have dealt with these things practically will be able to appreciate this now. See, if you look at the way payments are being made in the Indian context, in the case of Indian parties, generally 30 days to 60 days is the credit period which is given. Generally, I'm saying generally, this is the credit period given. So that means anyways, we are talking about more than 30 days. Correct? And even if the payment is not within time, that means even if the payment is not made within 30 days, this is still considered to be very much okay. Why? Because these are the practices which have got developed over a period of time. So I'm not saying the terms have changed. Maybe the term is that the customer needs to pay within next 30 days. But even if the customer pays within next 60 days, it is considered to be completely okay. So that's where we cannot just really apply this principle that because the payment is delayed or it's going beyond 30 days, so that's why we can just simply say that the credit risk for that party has increased significantly. Yeah. But this is something which I have talked about practically, okay, or you can say the practical aspect which is attached around this provision in the Indian scenario. For the purposes of your exam, you will have to just go by whatever it is written over here. You will not consider this practical aspect. You will have to just consider simple thing that in a question, if the fact will say that this has gone beyond 30 days, that means you'll have to consider that the risk has increased significantly. Okay, clear on this? Yeah. Okay, then it says an entity can rebut this presumption if the entity has reasonable and supportable information that is available without undue cost or effort that demonstrates that the credit risk has not increased significantly since initial recognition, even though the contractual payments are more than 30 days past due. When an entity determines that there have been significant increases in credit risk before the contractual payments are more than 30 days past due, the rebuttable presumption does not apply. Means it's not necessary that you will only consider that the payment has to go beyond 30 days and then you consider increase in significant risk. If the facts indicate, if the information is available on the basis of which we say that the payment is delayed beyond 30 days, but still that information indicates that the credit risk has not increased significantly, then you can just ignore this presumption. Or it may happen that after 10 days, means 30 days are not over, even after 10 days, there is an information which indicates increase in significant risk or a considerable increase in the risk. Yeah. So in that case, we'll not say that we'll have to wait for 30 days to call an increase in the credit risk as significant. No, even after 10 days, we can say the increase is significant now. All right. Yeah. Okay. So now what we can do is we can now get on to understanding one practical expedient. That means the way the provision will be computed. So all of these factors you have to just remember. An entity may use practical expedients when measuring ECL. So you can go to page number 12.99, please. Now this is important for your understanding. An entity may look at practical expedients. So now what is this practical expedient? Now we'll actually get on to the computation of provisions. Okay. Wherein this part that we are now going to discuss will be the most important part. We can say will be the most relevant part. Yeah. In the meantime, I missed certain queries. Let me just go to those queries also. Challa is asking, sir, whether practically it is possible to determine this stage, whether it is stage 1 or stage 2. See, as I told you that this is not something which will put down in the form of stage 1, 2 or 3. This is all a concept. For the purposes of your understanding, you need to understand as to how the provisions will change, how the credit risk will change. And practically, you'll never put any customer into a basket of say stage 1, stage 2 or stage 3. Practically, you'll create a provision. Yeah. But idea is for you to understand that there could be a portfolio, there could be a customer which would have moved from stage 1 to stage 2 or stage 3, for which the credit risk has increased, and that's why you should start increasing the provision. That's the relevance of these stages. Okay. Rohit is asking, sir, if as per the historical pattern, payments are not defaulted at any time, even then we will create a provision? Yes, even then we will create a provision. And once again, there's a reason for this. If you remember, we discussed two aspects. Provision is not only made on the basis of historical pattern. What was the other point which I told you? Forward looking. Standard is not only looking at the past, standard is also asking us to look at the future. And on a combined assessment, it is asking you to create a provision. It may be that a party had a very good rating, very good credit rating in the last 3 to 4 years. But since the last few months, we can see that the rating or the credit rating or the financial position of the party is deteriorating. And because of which, there could be an expectation that this party may default in future. Yes or no? Yeah. So now your historical pattern will not be able to help you to create a provision. So how will you be able to create a provision when you look at the future? Okay. So on the basis of your future or this estimate, the provision will have to be considered. Challa is asking, sir, why should we make a provision for credit loss? Because at the time of recognition of revenue as per Ind AS 115, at fair value only, why should we not adjust interest portion of fair value adjusted to ECL? Please explain it in an elaborate manner. So he's saying, sir, we need to get into the details of it. Now let's understand this, please. So it's a nice question which has been raised by him. And let's also try to understand how these two things are different. See, if you go to Ind AS 115, I'm not sure whether you have covered this or not. Maybe some of you might have read this. To my understanding, all of you are still not yet done in terms of Ind AS 115. Ind AS 115 talks about recognition of revenue. See, if you look at Ind AS 115, it asks you to recognize revenue, and the consideration at which the revenue will be recognized will again be the fair value. That is what Ind AS 115 says. And one may have a question that, sir, when we are recognizing a sale and which is being recognized at fair value, then how can we say that same day we are required to create a provision? Because are we not adjusting the sale amount with the amount of this ECL in that? The answer is no. Let's understand this with the help of a small example only, which will help us to understand this. Say a sale is made for 1,000 and now we have a trade receivable for 1,000 rupees. Correct? Now the first question is that, sir, if we are expecting a provision of say 10 rupees, then why should we not recognize sale amount of 990? Correct. Now for this, you will have to go to the principles of Ind AS 115, which requires you to go through a criteria. Once the criteria is fulfilled, only then you are able to recognize the revenue, otherwise not. And if that criteria is fulfilled, then you will recognize full revenue. Okay, what's the amount of full revenue? 1,000. In that criteria, Challa, if you have gone through that criteria, it is specifically mentioned that you will not consider any provisioning amount which is required to be created as per Ind AS 109. Maybe you can just go through this standard once again, all of you, or maybe later on when you read this, just remember that within those criteria, it's been specifically mentioned that any adjustment on account of ECL should not be considered at the time of recognition of revenue. Okay, because of which you will not adjust your revenue at that point of time. You will recognize this revenue fully. So what is the accounting entry you will pass? Trade receivable debit to revenue. 1,000. So the sale amount which has been recognized is what? 1,000. Now, after recognizing this, what is it that you are creating? You are creating a provision on this, a provision of 10, because of which it becomes 990. So what will be the accounting entry for this? You will say provision for ECL. Instead of doubtful debts, I should say provision for ECL. Debit 10. This will go to P&L. 2. Provision for ECL. 10. This will go to balance sheet. So the balance sheet amount is this. So this 2 provision for ECL is what? It comes over here. Provision for ECL. Yeah. And corresponding to this, there is another leg which goes to P&L. Okay. Now let's understand that's why it is done. Because again, you have a question. So this is something we know. You tell us why should this be done. So one point which I have explained to you, that the standard Ind AS 115 says that whenever you will recognize the revenue, it should be as per the criteria of 115, which specifically excludes any adjustment to be made on account of ECL. That is one. Secondly, you also need to understand the aspect that this is only a provision. This is not an actual number. It is not necessary that this 10 rupees will not be collected. Today we are creating an expectation, or we are only expecting a default of rupees 10. That doesn't mean that it's necessary that 10 will not be recovered. Okay, yeah. So that's why, what if this 10 is recovered? Let's suppose in future, if this 10 is recovered, there is no default on this. So would it mean that today we recognize revenue by 990, and later on when this gets recovered, at the time of recovery, we should create a revenue, or we should recognize a revenue of 10? Do you think this will be a right practice to be done? That means recognize revenue when it is collected. Do you think it will be appropriate to do that? The answer is no. That's why what do? You will recognize revenue in full, but at the same time, you will consider any provision. And once again, it's not necessary that the provision will come always. It's not necessary for each and every customer there will be a provision. No. There could be various customers, there could be various financial assets for which provision may not be required to be done. Okay, clear? I think Challa is clear on this. Very good. Rohit is now asking, Sir, if both historical pattern and the forward looking are good and doesn't have increase in significant risk, even then provision will be created. I'm hoping that I've just answered this question already. There's no necessity of provision. See, provision is not something which is mandatorily required to be created. It is something which will be created when required. And when is this required? When your historical pattern and your future expectations require you to create it. And that's why I'm telling you it's not a rule. See, unlike the provisioning norms, you remember for RBI we discussed for banks. For banks, RBI has a mandate that if it is a standard asset, create a provision at this percentage. If this is substandard asset, create a provision at this percentage. If this is a doubtful asset, create a provision at this percentage. If this is loss asset, create a provision at X percentage. Therein it's a rule. The moment you put an asset into a particular basket, you will necessarily create a provision. By default, it will be made for all the assets. But it's not so over here. It's not so over here. For each and every asset, you are not required to create a provision. Clear? All of you? Yeah? Okay. So now, let me just go back to that practical expedient which we touched upon briefly on the basis of our discussion only. But now we'll get into more details around it. So you can just go to this page number 12.9, please. An example of a practical expedient is the calculation of ECL on trade receivables using a provision matrix. The entity would use its historical credit loss experience for trade receivable. A provision matrix might, for example, specify fixed provision rates depending on number of days that a trade receivable is past due. For example, 1% if not past due, 2% if less than 30 days past due, 3% if more than 30 days past due, and so on. Depending on the diversity of its customer base, the entity would use appropriate groupings. If its historical credit loss experience shows significantly different loss patterns for different customer segments. Examples of criteria that might be used to group assets include geographical region, product type, customer rating, collateral or trade credit, insurance, and type of customers such as wholesaler or retailer. Now, what is this practical expedient? And how is this provision actually created practically? See, all of these guidances that we have discussed so far, they are all relevant, but their relevance will be in the context of this provision matrix. Now, what is this matrix? Let's understand this. What the entities will do, or they have been doing, is to create a provision matrix, something like this. So they will say how many of their trade receivables fall into aging bucket of 0 to 30 days. So you can say this is aging. Yeah, 0 to 30. Then it can be 30 to 60, then 60 to 90, then 90 to 180, then more than 180 days, less than 1 year, or less than equal to 1 year, more than 1 year, less than equal to 3 years and more than 3 years. Let's suppose these are the aging buckets which have been created, and it can be further drilled down. Yeah, so I'm just taking this as an example. And within these aging buckets, what do? We will put down the trade receivables or the financial assets. Let's suppose the financial assets which will fall under this bucket, say this is 1,000 rupees, say over here it's 15,000, and say over here it's 14,000. Yeah, say over here it's 20,000. In fact, this should be more. Huh? In fact, this should be the highest one. The highest one will generally be in this bucket. Say it's 1 lakh. Say it's 19,000. Okay. So what have we tried to do? We have tried to bucket the total receivable into these age buckets. Yeah. On the basis of the aging of the customers, these bucketing have been created, and we have put the amounts around it. Yeah. Now, what's the next step? Next step is, so this is the amount, the trade receivable. Next step is percentage of provision. Percentage of provision. Now, on the basis of various factors, we will have to check that generally the customers which stay in this bucket, means the customer more than 3 years old, on the basis of the historical pattern, what do we collect? So we say that if a customer goes beyond 1 year bucket, then generally 10% is the default. Generally 10% is the default. If a customer goes beyond 3 years, then generally 30% is the default. Similarly, if we say for 30 to 60 days, say 1% is the default, and over here let's suppose 0.2% is the default. Here we say 2% is the default. Here we say 4% is the default, and here we say 4.5% is the default. Now this is something which we have again created for each and every bucket. And how do we create this percentage? There are various factors for doing this. It could be on the basis of customer basis. Maybe we can say that all these customers for which we have assessed these percentages, they belong to a particular region. So we can say that the entity has been selling into 2 locations. One is, say, North. So these are the trade receivables for North. Yeah, and for them, this is the percentage. Similarly, entity can put down the amount of trade receivable for, say, Eastern region. So what have been the amounts and what have been the percentages of default? Correct? Or it could be a combined, wherein the entity doesn't want to just break it on the basis of regions. It could also be done on the basis of customer category. Maybe that this is for wholesalers, this is for retailers. Maybe this is for export sales, this is for domestic one. There can be so many criterias, and this is again not limited to only 2. This can further be bucketed into 5 categories, and for each category we can divide the amount and the percentage of default. Yeah. Now for us, what's the most important point? For us, the most important point is these percentages. These percentages are the most important point for us to get onto this percentage, because this is the percentage using which provision will be created. So that's why, where do we need to go? We need to go to this percentage eventually. If we are able to get this percentage right, then we can very easily create a provision. How? So what will be the provision amount for this company? Very simple, 1 lakh into 0.2%. 15,000 into 1%, so on. And the total of these amounts will be the amount of provision percentage. Total of these amounts will be the amount of total provision as per ECL. So this matrix that we have created is very commonly called as provision matrix. Every company creates this provision matrix. And in this provision matrix, you will see that even if a trade receivable is not overdue, because every entity will at least give 30 days credit period. Will at least give 30 days credit period. So you can see that even if a trade receivable is within a bracket of 30 days, there are chances that provision is created on that. And why is that so? Now question arises that, sir, why should we create a provision on this bucket? For more than 30 days, we can understand that 30 days is the credit period. Let's assume 30 days is the credit period. So we can understand for all other buckets. But something which has not even become due, why we are creating a provision for this? Therein the standard says that something which has moved to this bucket, it's not something that originally any trade receivable would belong to this bucket. No. If a trade receivable has fallen into this bucket, what does this indicate? That initially that would have been this in this bucket, and from this bucket that would have moved to this bucket. So that means that there are chances, there are patterns in the history on the basis of which we can track that what is the probability, what is the percentage that this bucket becomes this bucket after a certain period of time. And that will become the basis for determination of this percentage. Okay. And once we get the percentage, then it becomes very, very simple for us to solve this. Yeah, clear? Clear on this? So now we can move to illustration number 30, which is on page 12.99. We can just now get on to this, please. Illustration number 30. Start reading this illustration, please. You can just start solving this also. I'm just hoping that you would be finding this topic interesting and easy also. Yeah. Entity A originates a single 10-year amortizing loan for 1 million. Taking into consideration the expectations for instruments with similar credit risk, using reasonable and supportable information that is available without undue cost or effort, the credit risk of the borrower, and the economic outlook for the next 12 months, entity A estimates that the loan at initial recognition has a probability of default of 0.5% over the next 12 months. Entity A also determines that changes in the 12-month probability of default are a reasonable approximation of the changes in the lifetime probability of default for determining whether there's been a significant increase in the credit risk since initial recognition. Loss given default is estimated as 25% of the balance outstanding. You are required to calculate the amount of provision. That's it. Yeah. You are simply required to do one thing. Amount of provision. Loss allowance. Loss allowance is what? Allowance for loss. Means expected credit loss allowance. Means provision. Okay. Now, how do we do this? If you look at the reporting date, no change in 12-month probability of default, and the entity assesses that there is no significant increase in the credit risk since initial recognition. Therefore, lifetime ECL is not required to be recognized. Correct? That's clear from the facts of the question itself. So what's the loan amount? So the loan amount is given as 1 million. Loan amount means the financial asset is given as 1 million. Okay. And we are also given a percentage of loss given default. 25% of the balance outstanding. %25 of balance outstanding. Yeah. Probability of default for 12 months ECL. In this case, we don't need to go from 12-month ECL to lifetime ECL. So for 12-month ECL, what's the probability of default? 0.5%. So how do we create a provision? How do we compute the ECL? So what will be ECL? 10 lakhs into 25% into 0.5%. Simple to do. Yes or no? Yeah. So what's the amount? All of you, can you compute this quickly and let me know what's the amount? What's the amount? 1250. Yeah. Easy to be done. Correct. Okay, Challa has a question. Challa is saying, sir, one more question on this. While creating ECL, there is a clause of temporary difference exists as per Ind AS 12. How can we differ it as per Ind AS 12? I didn't understand your question, Challa. Maybe you can just elaborate this, please. Why you are considering this point? If you are talking about temporary difference, then of course temporary difference will arise because any provision gets disallowed and temporarily. Yeah, if that's the question. Maybe you can just clarify this further. Okay, moving on to next illustration, please. Illustration number 31, page 12.100. Bank A originates 2000 bullet loans with a total gross carrying amount of 5 lakh. So what's the total gross carrying amount? Total gross carrying amount is 5 lakh. Yeah. Bank A segments its portfolio into borrower groups X and Y on the basis of shared credit risk characteristics at initial recognition. Group X comprises 1000 loans with a gross carrying amount per client of 200 for a total gross carrying amount of 2 lakh. Group Y comprises 1000 loans with a gross carrying amount per client of 300 for a total gross carrying amount of 3 lakh. So there are two groups into which this is divided. Group X and Group Y. So what's the total amount in Group X? 2 lakh. And for the total amount of Group Y, it will be then 3 lakh. Yeah, it will be then 3 lakh. And out of 2000 loans which have been originated, what's the scenario? 1000 loans are over here, 1000 loans are over here. And of course, it will be 200 per loan, it will be 300 per loan. Yeah. There are no transaction costs and the loan contracts include no options. For example, prepayment or call options are not there. No premium, no discount, no points paid or other fees. You are required to calculate the rate of loss when. Okay, so there are a couple of situations which are given. When for Group X, historic per annum average default is 4 and present value of observed loss is 600. Yeah. So for Group Y, historic per annum average default is what? 2. And present value of observed loss, which is assumed, is 450. Okay. In this scenario, we need to answer this. Yeah. Clear on the fact pattern. So we can go to the solution now. All of you. We can go to the solution now. So I have to just clear this part for the space. Bank A measures ECL on the basis of loss rate approach for groups X and Y. In order to develop its loss rates, Bank A considers samples of its own historical default and loss experience for those types of loans. In addition, Bank A considers forward-looking information. So one is the historical pattern. So one is the historical pattern bank will consider. And second will be the forward-looking outlook. Yeah, couple of things will be considered by the bank. Yeah. Bank A considers forward-looking information and updates its historical information for current economic conditions as well as reasonable and supportable forecasts of future economic conditions. Historically, for a population of 1000 loans in each group, X rate loss are 0.3% based on 4 defaults, and historical rate loss rates for group Y are 0.15% based on 2 defaults. Yeah. Okay. Now moving further, what do we need to do? We need to just put down this information in the form of a table, something like which they have done. So let's put down this information and automatically we'll be able to derive this loss rate. So let's see. So we have two groups, group X and Y. So we begin with the number of loans which they have given. Yeah. So remember 2000 were the bullet loans. So number of loans, or we can say number of clients. So 1000 was here and 1000 was here. At both the places number is 1000. Right? Then estimated per client gross carrying amount at default. Estimated per client gross carrying amount at default. This is also given to us. For group X, it was 200. For group Y, it was 300. Okay. Next, total estimated gross carrying amount at default. This is something which is again given to us. Total gross carrying amount at default. So this was also given in the question itself. Yeah. Historic per annum average defaults. This is also available in the question. Historic per annum average defaults. So what's the percentage? 4 and 2. This is 4, this is 2. Yeah, and you can just sort of create this table for the purpose of better understanding. Okay, yeah. Now, what can we compute? What is the estimated total gross carrying amount at default? Estimated total gross carrying amount at default. Yeah. And how do we compute it? Very simply. So this is A for us. And this is B for us. This is A for us. This is this we can mark as B. This we can mark as C. This is D, or we can write it over here. This is D. This is E. So what is E for us? B into D. $200 into 4, 800. 300 into 2, 600. E is B into D. If you want, you can just also write down the formula, please. B into D. Okay. Next, present value of observed loss assumed. That is also given. Present value of observed loss assumed. That is also available to us in the question itself, and that is 600 and 450. This is 600 and 450. We can mark it as F. And next will be G. And G is what? Now we need to get on to the loss rate. Now, this is where we computed the percentages that we discussed, 0.3% and 0.15%. And what are these percentages? Very simply, we can just divide this F by C. So if you do that, F divided by C, what do you get? 0.3%, 0.15%. Yeah. Correct? All of you? Now what we can do is we can just once again go back to this para and now try to understand this second para. Bank A considers forward-looking information and updates its historical information for current economic conditions as well as reasonable and supportable forecasts of future economic conditions. Historically, for a population of 1,000 loans, in each group, loss rate of X is 0.3% based on 4 defaults, and loss rates of Y are 0.15% based on 2 defaults. Correct? Clear on this, all of you? Yeah? All of you clear on this? Yeah? Okay. So before we move on to the next question, let me just come back to your queries. If you have any, then we can move on to the next illustration as well. Illustration number 32. You can also start solving this in the meantime. If you feel you are comfortable with this topic now, you can start solving the next illustration. I would say very, very easy. Out of all of these illustrations that we have done, that will be the most easy. So let me just come to your queries now. Okay, Chala has a query. He is asking, sir, further to my previous question, temporary difference will arise due to creating ECL for FAs. How to defer the losses if the company expectation on such kind of FAs, that is percentage of default, will get changed. In this case, how to defer temporary difference as per Ind AS 12. Please go through it, sir. Sure. So what we can also do is, while I answer the question of Chella, we can also take a break of 10 minutes. Yeah. And if you have any other query, you can also send your query right now. So what we will do is we'll go on for this illustration after the break. So now as regards your query, you need to just keep it very, very simple. Instead of just getting into what is this ECL, what is not an ECL, how will the amount change, how will the loss allowance change, I don't think you need to get into that. Just keep it simple in a way that any loss allowance will not be accepted by the tax. Why? Because the tax will not go by the provision. Tax will say that the provisions are not acceptable to me. So what they will do is they will disallow this amount in the current year. And in case there's a default, this is not recovered, and when you write it off, that is when they will allow it. So that's why it will become a temporary difference. Or let's suppose you have created a provision in the current year which they have disallowed, but which will then subsequently be recovered by you. Then you will reverse the provision. Therein again in the books will get settled. Okay, so therein the provision amount, because it is getting reversed, that's why also temporary difference will get settled. So this is how you need to look at it, very simply. Okay, clear on this, children? Yeah. So now we can take a break of 10 minutes, and after the break we will continue with our discussion on ECL. We'll start with illustration number 32. In the meantime, if you have any more queries, please send your query and we'll just also address that after the break. Sure? Yeah. Hi, welcome back. So we can now continue. Yeah. So let's move on to illustration number 32. And in case you have solved this illustration, you can just start sharing your responses also. Okay. Yeah. I'm sure many of you would have gone through this illustration already. They would have solved this. Yeah. Company M, a manufacturer, has a portfolio of trade receivables of 30 million in 2000X1 and operates only in one geographical region. The customer base consists of large number of small clients and trade receivables are categorized by common risk characteristics that are representative of the customer's abilities to pay all amounts due in accordance with the terms of the contract. Trade receivables do not have any significant financing component in accordance with Ind AS 115. In accordance with para 5.5.15 of Ind AS 109, the loss allowance for such trade receivables is always measured at an amount equal to lifetime expected credit losses, something we also know. Please use the following information of the trade receivables outstanding. So we have the bucketing available for various trade receivables, and the total trade receivables are 30 million. Company M uses following default bucketing percentages. That means the provision matrix is also given in the question itself. That for various buckets, what is the default percentage? You are required to determine what? Very simple, ECL. Can you do this on your own? Yeah. All of you, if you have done this on your own, can you please start sharing your answers? And in case you have not done this, can you just go through this quickly and let me know what will be your answer? I think it's very, very simple. It shouldn't take you more than 2 to 3 minutes to compute this amount. Yes, quickly. I'm waiting for your responses. So I'll also take a pause for a couple of minutes for you to solve this and let me know the answer. And then I'll go to the solution. All of you, please compute this and let me know the answer. And in case you have done that, or whenever you do that, please keep sharing your answers. But you need to do this quickly. Okay, so we can begin with the solution now. Yeah. All right. To determine the ECL for this portfolio, company M uses a provision matrix, which is available. The provision matrix is based on historical observed default rates over the expected life of trade receivables and is also adjusted for forward-looking estimates. So this is not only based on historical pattern. Forward-looking estimates are also considered in this. At every reporting date, the historical observed default rates are updated and changes in the forward-looking estimates are analyzed. Correct? This is something which is the requirement of the standard. So for us, it doesn't matter because we don't have various reporting dates. It's all about understanding of the concept that this is something which will have to be revised year on year. In this case, it's the forecast that the economic conditions will deteriorate over the next year. On that basis, company M estimates the following provision metrics. So they have this provision metrics available. So let's put down this information into the form of a table. So we have various buckets available. So one is current, then we have 1 to 30, then we have 31 to 60, then we have 61 to 90, and then we have more than 90 days. So these are all days. We also have the amounts bucketed under this. So this is aging. Then we have the amount. So what's the amount? 15 million, 7.5 million. Yeah. Then we have 4 million, 2.5 million. And then we have 1 million. Okay, all in all, this becomes 30 million. Correct? Then we are also given the default percentage. For each bucket, default percentage is available. It's 0.3% over here. Then we have 1.6 over here, 3.6 over here, then 6.6 and 10.6. Correct? Now, what is required to be done? ECL. How do we compute ECL? Very simply. So if this is A and this is B, what will be the amount of ECL? Simply A into B. Yeah, A into B. Can you start computing these amounts now and tell me the answer? This is what? This can also be termed as gross carrying amount. And this is what? This is the lifetime ECL percentage. Both of them are available in the question itself. You are just required to compute the amounts. Can you quickly compute the amounts and let me know? Now it's all computation only. Yes, quickly. Is this easy or not? As I told you, this is the simplest one out of all the questions that we would have covered. And this is how you create provision. See, in terms of creating a provision, what's the most difficult part? Anybody would say the most difficult part would be to get onto this percentage. Something which we computed in the last question. Because these are what? These are your receivables for which aging analysis will also be available. Correct? And if you get this percentage, then the ECL is a very simple computation. What is the most difficult thing to do to get onto this probability of default or this percentage default? Yeah. Once this is available, then it can be just solved by multiplying the gross carrying amount with the percentage of default. So this becomes 45,000 over here. And this is what? This will be 1,20,000, 1,44,000, This will be 165 and 106. Yeah. All in all, what's the number? 5,80,000. Okay. Yeah. This is how we compute the ECL. Any questions, any doubts in case you have on this, please let me know. This is all about ECL. In case you have any questions on this, any doubts on this, please let me know. Yes, quickly. Any questions from your side? Any doubts from your side on this? No? So should we move further? Yeah? Okay, so let's move further then. So with this, we are done with the impairment that is required to be created on financial assets. And always remember that this is not the only impairment. We have another standard on impairment which would deal with non-financial assets or those assets which are not covered under Ind AS 109. Okay, yeah. For Ind AS 109, the specific assets that have been covered are specified. Okay, yeah, clear. So now we will move on to disclosure requirements. Okay. Disclosures is something which you would generally see are being picked up when we complete a particular topic or when we complete a particular standard. See, if I talk about financial instruments, I would say we are largely done with everything. There are few things which are yet to be covered by us. One, hedge accounting. Second, the computation of EIR. Many of you have asked me, sir, how do we compute EIR? Can we please get onto that computation? And as I told you that this concept has nothing to do with financial instruments. It's all about computing it, and which is not linked to financial instruments. So that's why I have parked it. Okay, but parked it doesn't mean that this will not be done. Of course, this will be done. So I'm saying this is also something which we need to do, but I plan to do it later on. The next thing that we are left in this standard is about the disclosures that we plan to do now. So the plan is that after completing the disclosures, we will start solving the illustrations, various illustrations, and which is all about practicing the concepts. And the same thing I plan to do in the next session also. So hedge accounting is not something that we'll do today. We'll do hedge accounting in the next session. EIR computation is again something which we'll do in the next session. And some questions we will practice in the next session. And most of these questions that we are now going to practice will be based on various concepts that we have discussed in the last sessions of financial instruments. And that's why it will be extremely important for you to remember all the concepts that we have discussed so far. Only then you will be able to practice those questions. Because even though we will be practicing those questions in the class, in the session, it will be beneficial that you also are able to solve those questions. Because at the end, what's the thing that we want to achieve? That we should be able to solve the questions in the exam. If we are not able to do that, then what's the objective of getting into all of these discussions? Isn't it? Yeah. So maybe once again today, some of you may not feel comfortable when we solve illustrations, which may be related to the topics that we say. covered in the second session or third session or fourth session. And that is because you may not be able to remember all of those points. And that's why I kept saying that revision of this particular topic is very, very important. And that's why, once again, my request to all of you that please make sure that you revise all the things that we have discussed so far so that you can appreciate various illustrations that we plan to cover in the next session. Okay, yeah. So without wasting any further time, I will now move on to the disclosures before moving on to the illustrations. So I would suggest all of you to please open your study material, unit number 6. Go to page number 12.144 for disclosures. See, for disclosures, I told you one thing when we began with this topic, that under Ind AS, as compared to Indian GAAP, the size of financial statements of an entity generally doubles up. You remember that point? And I also told you one thing, that a major contributor or one of the reasons why that size of the financial statement increases significantly in terms of number of pages is because of the disclosures which various Ind AS require. It's not about any particular Ind AS, various Ind AS requires. And out of those various Ind AS, one of the biggest reasons for the increase in the size, for the increase in the number of disclosures, one of the standard which contributes significantly to this happens to be Ind AS 107. The disclosure requirements under this particular standard are extensive. This standard once again runs into so many pages. And only on disclosures. Can you understand how this standard is only on disclosures and this is running into so many pages. So this is not limited to 10 to 15 pages, running into I think somewhere around 80 to 100 pages. So that is why the disclosure requirements are also extensive. Now, all this while that you would have seen in case of various topics and in your previous discussions also you would have seen that disclosures are not something that we have been covering in so much detail like it's there in the standard. As I told you that the disclosure requirements for this particular standard are also extensive. But you need not worry about it. We are not getting into such an extensive requirement for the purposes of our discussion or for the purposes of our exam. So at least you are relieved to that extent in relation to the disclosure requirements. But at the same time, it's very important to understand those limited disclosures that we plan to cover. But even if this is a sort of relief which is available to you right now, there's something which will have to be understood by you, which will have to be applied by you practically when you qualify later on, or maybe some of you who might be working on the financial statements right now as per Ind AS. So that's why, even though we will be covering this particular disclosure element in a brief manner, I would advise all of you, whenever you have time, to go through the requirements of the disclosure requirements in more detail through the help of Ind AS 107. And for this, the best way will be to go through the annual reports of the listed companies. Because in the annual report of a listed company, you would be able to see how all of those disclosures have been given, wherein you will be able to better understand the disclosure requirements as to how those are given in the financial statements. Okay, yeah. So now, coming to the disclosure requirements, please move on to page number 12.144. We will start with the balance sheet. And in fact, what we can also do is, it's a sort of recap which we can do with the help of the disclosure requirements. Because in terms of disclosure requirements, it's very easy to understand that whatever will get recognized or measured will have some disclosure requirements, or will generally have some disclosure requirements. So that's why what we can also do is, let's go with the flow with which we started our discussion since the beginning, and through that I'll just keep telling you what will be the various disclosure requirements, and which can also relate later on to the discussion which is there in the study material. Yeah, clear? Okay. So we started our discussion with financial assets. Remember? And on the financial assets, we started our discussion with the classification. Amortized cost, fair value through PL, fair value through OCL. This is something we started with, if you remember. And we discussed that at the time of initial recognition, all the financial assets will be measured at fair value. At the time of subsequent measurement, they will be measured on the basis of their bucketing criteria. Yeah, this is something that we started with. Now let's understand the disclosure requirements which we can correlate with this. All of these financial assets, the way those are required to be classified, will have to be disclosed in the financial statements. And in case financial assets are measured at fair value, then there are certain disclosure requirements of fair valuation which will have to be given in the financial statements. And for this, you can also go to the discussion that we had under Ind AS 113 on fair valuation. Therein also we briefly touched upon the requirements of disclosure in the financial statements when the fair valuation is done. Okay. Now, one is the classification. So this classification will have to be presented and disclosed in the financial statement. Second is, in case an asset is measured at amortized cost, then in terms of its amortized cost, some discount rate would have been used by the entity. So that discount rate is also required to be disclosed, using which financial assets or a particular financial asset or maybe different financial assets would have been measured by an entity. Clear? Clear? All of you? Okay. Now, other than the financial assets, we also discussed about financial liabilities, for which once again we did some bucketing. One was amortized cost and second was fair value through PL. Once again, for the financial liabilities, what do we need to consider? Same thing. For the financial liabilities also, disclosures will be required to be given for their bucketing, for their classification. Disclosures will also be required to be given because they will also be initially measured at fair value. So the fair valuation principles will use, the fair valuation methodology will use, that will be required to be disclosed. And when it is subsequently measured, then their measurement, which is dependent on their classification, will have to be disclosed. Therein again, the fair valuation which will come will have disclosure requirements. Therein again, if the amortized cost is used, then the EIR rate, the discount rate, yeah, all of these things will be required to be disclosed in the financial statements. Correct? Yeah. Third thing that we discussed was about equity. Now, some of the instruments which may have the legal form of a debt, but which may get classified as equity, will be required to be disclosed. And where do you disclose it? Statement of changes in equity. Yes or no? And some of the instrument may become compound financial instruments. Therein again, what will you do? You will segregate them into financial liability and equity. And once again, you will have to disclose them. Some under financial liabilities, the way we have discussed, and some under equity in the statement of changes in equity. Correct? Any movement which takes place during the year will again be required to be disclosed. Where? In the statement of changes in equity. Correct? That will also be required to be disclosed in the statement of changes in equity. Okay. How do we measure equity? Equity is measured at cost if you look at it from the issuer's perspective. So that's why it will continue to remain over there at cost. Yeah. And this is something which can be easily understood by looking at the statement of changes in equity. Right? Okay. Now, in relation to all these three, there could be certain instruments which may be compound, but for the holder, do we need to consider anything different on that? No. For the holder, our assessment will go over this. So do we need any further disclosures to be considered on the basis of that pattern? No. No further requirements are there. Correct? Clear on this? Yeah. So we have understood some of the disclosure requirements on the basis of these three categories. Yeah. Okay. Then moving further. What was the next thing that we discussed? If any of you can let me know. Other than this, what was it that we discussed? So it's all recap in a way that we have been doing. Yeah. So can you tell me, other than this, what is it that we discussed? Because accordingly, we will have to understand the disclosure requirements. Accordingly, we can pick up the disclosure requirements. Yes or no? Yeah. So the next thing was about derivatives and embedded derivatives. Now for both of them, once again, what do? We disclose how a particular instrument has been considered to be a derivative. Derivatives are measured at fair value initially as well as subsequent on measurement. So that means the disclosures around fair valuation will have to be given. For embedded derivative, there was once again a flow that we discussed, that whether the host instrument will be in the nature of asset. If yes or no, then we decide how will that be measured, whether we segregate it or we don't segregate it. Correct? Then for the host instrument, we also discussed that we need to check that whether the economic characteristics, whether the risks which are attached to the derivative are closely related to the host instrument or not, because accordingly we segregate it or we don't segregate it. So some of those principles are also required to be disclosed. Correct? Yeah. So these are the disclosures that we can think of in terms of derivatives and embedded derivatives. Then we moved on to reclassification. We understood that reclassification is only possible for financial assets. For financial liabilities, no reclassification is possible. It's not allowed. That's why, what do we need to do? We need to give the disclosures whenever a financial asset gets reclassified. Why? Because this indicates that the business model of the entity has got changed. And if the business model of the entity has got changed, a disclosure will be required to be given. Correct? And the reclassification will have to be given. And also the fact that it is prospective will have to be given, because it can't be retrospective until unless we say that there has been an error. Correct? Yeah. So the reclassification will also be required to be disclosed. Now, after the reclassification, what did we discuss? Embedded derivative we have discussed, derivatives we have discussed. So what is the next thing that we picked up? Tell me. It was about derecognition. Yeah. So for financial assets, for financial liabilities, we discussed their derecognition criteria. Now it may happen that the financial asset is not fully collected, it's not fully recovered, but we may be required to derecognize it. If you remember that flow chart. Now, whenever you are derecognizing a financial asset, when it's not fully collected, what do? You will disclose the terms. Or in case a financial asset is derecognized, but a continuing asset on that is recognized, that is again required to be disclosed. Then we move on to the financial liabilities. For financial liabilities, derecognition requires one test to be performed first of all. What was that test called as? 10% test. On the basis of which we check whether the change in terms should be called as a modification or an extinguishment. Accordingly, its accounting varies. So whenever there is a modification, it's required to be disclosed in the financial statements. Whenever there is an extinguishment, means the change is so substantial, it's crossing 10% or 10% is the change, then the extinguishment rules will have to apply. That is also required to be disclosed. Correct? Yeah? Okay. Then after this, what did we discuss? After this, what did we discuss? After this, we discussed about impairment. Yeah? Something which is fresh in your minds. And this is, I'm hoping, because I'm receiving very, very few responses from your side. So that's why I'm hoping that all of you are with me today. And I'm hoping that this is a sort of revision wherein you would have understood that so many things have been covered and so many things are yet to be revised. Is it? Yeah? Okay. Now, in terms of impairment, there are a lot of things which are required to be considered for disclosure. One, that is the provision matrix. Provision matrix will have to be disclosed in the financial statements. Second, when the financial assets are there for which credit risk is deteriorating, so their bucketing is changing, or when the credit risk is deteriorating, some of the financial assets may move from 12-month ECL to lifetime ECL. So this again is required to be disclosed in the financial statements. Correct? Other than this, there's one more topic on hedge accounting that we have not yet covered. So some disclosures around hedge accounting are also required to be given. Okay, so when we'll cover hedge accounting, you'll understand a perspective around those disclosures as well. Okay, yeah. So this was broadly a coverage of various disclosure requirements that we have under Ind AS 107, and this is not the end of the disclosures. There are various other disclosures that we plan to discuss now. See, my idea to take you through this approach was to make you understand that whenever you will be required to disclose anything, you can just try to correlate that, link that with various items which would have been recognized in the financial statements, because most of the disclosures will revolve around it. Yeah, clear? Okay. So with this, if we'll go through the study material now, and I would advise all you to just flip through the study material, yeah, along with me, so that you can just understand that whether we have discussed all of these disclosures which are there in the study material, you will say you will say yes to most of the points. Okay. So you can just flip through page number 1, page number 2, page number 3. That means 12.147. All of these things are required to be disclosed. Can you just go through this part quickly? Yeah. All of these things you will get to see that yes, we have covered. Just ignore the technical language which may have been written, which is not really something that we need to go right now on. You can just read this later on. Up to page number 12.151, I would suggest all of you to flip through the pages. And in case you have any doubt up to that, you may ask me. Because after that, I'm starting with a new set of disclosures, which I have not yet discussed, but which are again forming part of the standard and which needs to be discussed now. Yeah. Any questions, any doubts in case you have on these pages? No, clear on this? Okay, perfect. Now, other than these disclosures that we have discussed, which you will be thinking, sir, so many disclosures are there. Do we have any more disclosures? Yes. This standard also requires you to explain the risks to which an entity is subject to. What are those risks? You can say one is the credit risk to which an entity will be subject to. One could be the liquidity risk. One could be the foreign exchange risk. One could be the market risk to which an entity is subject to. All of these risks are required to be disclosed in the financial statements in quantitative as well as qualitative form. In quantitative form would mean that if there are assets or liabilities in the financial statements which become subject to credit risk, or which will involve liquidity risk, or which will involve market risk, those are required to be put down under those risk categories. Okay. Yeah. And in terms of qualitative assessment, it means that you will be required to give a commentary in the financial statements, in the disclosure, in the notes to the financial statements. An entity will be required to give an elaborate note that how that particular risk is impacting the entity and may impact the entity in terms of its business. And not only the impact which the risk may have on the entity, how is the entity mitigating that risk? That will also be required to be explained by the entity. Okay. So in a way, if you look at this risk assessment which the entity might have done, and which may be documented by the entity in some of its internal documents will now be required to be will now be required to be disclosed in the financial statement. So that doesn't mean that it will be running into this hundred of pages in terms of the manuals which the entity may have. All of those are required to be made part of the financial statements now. No, it's only the relevant disclosure. It's only the part of those manuals in case the entity is having any sort of SOPs, etc., from which some of these points may be picked up. And one more thing which you also need to appreciate under Ind AS is that even though we have been talking about extensive disclosures, not only as part of this standard, but through various other Ind AS also, all of those disclosures have to be relevant. Ind AS doesn't require you to give just disclosure for sake of giving it, or just put too much disclosures which may not be really relevant or useful for the financial statements. No, that is also not required. Ind AS also requires that only the information which is relevant and for the use of the users should be included in the financial statements. And all of these points that we have discussed so far in terms of the disclosure requirements are all considered to be relevant for the users of the financial statements. Okay, yeah, clear on this? So we can just now flip through all of these disclosures. Qualitative disclosures. For each type of risk arising from the financial instruments, an entity shall disclose exposure to the risk and how they arise. So I am on page number 12.152. Okay, and this is about nature and extent of risks. Yeah, so this is the part that I am discussing with you. Yeah, I am talking about qualitative disclosures. So what is the requirement of the standard? Standard says for each type of risk arising from financial instruments, an entity shall disclose exposure to the risk and how they arise, its objectives, means what's the objective of the entity, policies, processes for managing the risk, and the methods used to measure the risk, and any changes if they arise in point number A or point number B as compared to what it was in the comparative years, in the previous years. Okay, yeah. Let me just go to one query now. This comes from Challa. Challa is asking, sir, provision for ECL metrics should be disclosed in the notes to accounts of Ind AS companies, whether provision is created or not. So that provision metrics, that complete table is required to be disclosed. So it's not only about whether ECL is created or not. For whether ECL is created or not, that will be a print in the form of disclosure in the accounting policy. And that can also be viewed from various other disclosures which will move into the notes. This provision matrix, that complete table, is also required to be included there. Okay, yeah. So now coming back to this. So I'm on the same page. So now I'm discussing about quantitative disclosures. Quantitative disclosures. So the standard says for each type of risk arising from financial instruments, including credit risk, liquidity risk, market risk, including means that we are not saying that only these three could be the risks. Other than this, other risks are also possible. For example, I told you, foreign currency exchange risk. Yeah. Now for this, Under quantitative disclosures, what will the entity disclose? Summary quantitative data about its exposure to that risk at the end of the reporting period. This disclosure shall be based on the information provided internally to key management personnel of the entity, for example, board of directors of the entity or the chief executive officer. Certain detailed disclosures required for each type of risk mentioned above to the extent not provided in accordance with A. Concentration of risk if not apparent from disclosures made in accordance with A and B. Then the standard says, if the quantitative data disclosed as at the end of the reporting period are unrepresentative of the entity's exposure to risk during the period, an entity shall provide further information that is representative. Okay, what does this indicate? That the disclosure has to be meaningful. If the disclosure is not meaningful, there is no reason to give it. There is no point giving it. Okay. What we can now do is, maybe we can pick up one type of risk, and on the basis of this, we can understand what all disclosures, etc., would be required to be included. And for this, what I'll do is, I'll not pick up a big one because it may be too bulky and it may become sort of theoretical only. Yeah. So I have moved on to liquidity risk, which is page number 12.156. This is about liquidity risk. So let's understand what will be required to be disclosed. An entity shall disclose a maturity analysis for non-derivative financial liabilities, including issued financial guarantee contracts that shows the remaining contractual maturities, a maturity analysis for derivative financial liabilities. Okay, the maturity analysis shall include remaining contractual maturities for those derivative financial liabilities for which contractual maturities are essential for understanding of the timing of cash flows, a description of how it manages the liquidity risk inherent in A and B. Okay, yeah. And the other risks are also specified. And if you look at the end of this chapter, there's a note which I also told you, which is very important, that you are required to go through this standard for better understanding of complete disclosure requirements as per this standard. Okay, clear? Yeah. Okay. Yeah. So now, as we discussed, we can move on to some examples, some illustrations. So let me just pick up some examples now. Okay, so, and I would suggest all of you to please answer these questions. Huh? Yeah. Okay, so we can go to illustration number 10 on page 12.21. Illustration number 10 on page 2.21. Small one and easy to understand. And I'm hoping this will be very, very easy for all of you. And I want all of you to answer this now, huh? Because now it's all about practicing. Now we are only done with one topic. hedge accounting. Otherwise, you can just understand that we are done with the financial instruments. So that's why it's all about practicing more and more questions, and that's it. So that's why now your involvement becomes extremely important, because I can just keep solving the questions. But if you don't participate, if you don't solve that on your own, then it will not be very useful for you. Okay. All right. So A Limited issues warrants to all existing shareholders. A Limited issues warrants to all existing shareholders. Yeah, warrants are issued. Warrants are some instruments. These warrants entitle the shareholders to purchase additional equity shares of A Limited with a face value of rupees 100 per share at an issue price of rupees 150 per share if they want. Evaluate whether this constitutes an equity instrument or a financial liability. Now you are required to check whether this will become equity instrument or a financial liability. And I think it's very, very easy for you to answer. Yes, quickly. Challa has one query. Challa is asking, sir, how to analyze maturity financial guarantees as a liquidity risk? Please give some inputs on that, because I am willing to do such kind of analysis. See, Challa, that's why I told you that for this type of understanding and to get into more details, one very simple step is available to us. Just go through the financial statements of any company. Therein, all of these disclosures will be available to you. And from there, you will be able to do this very, very quickly. So what I can do is, in the next session, I can also plan to include some examples of those companies as to how these are presented as the time permits. Okay. Otherwise, you can just open the financial statements of any company which is on Ind AS. So pick up any listed company and you will be getting complete clarity around it. Still, if you don't get it, let me know. Yeah. Okay. Now on this illustration, I'm waiting for your response quickly. What will be your answer? You need to be quick, please. Yes, quickly. What will be your answer? Waiting for your response. Yes, all of you, quickly, please. What is your answer? Okay, Kunal has answered this. Very good. Kunal is saying that it should become equity instrument, and I think it's yes. What about others? It will be great if you can also let me know the reason. Chella is saying that it should be equity because there is no compulsory obligation to the company. That means A to pay cash. That's correct. What about others? All of you, please remember that you should now be prepared to answer all of these questions, because all of these things are done. We are only practicing the questions. So let's understand this now. Company A has issued warrants. A Limited has issued warrants which entitle equity shareholders who are existing to purchase the shares of the company at a fixed price. So what's the price at which they can purchase? They can purchase at the rate rupees 150 per share. So this price is prefixed, fixed now. Hence, it constitutes a contractual arrangement for issuance of fixed number of shares against fixed amount of cash. So if you look at it from A's side, what will A be required to do? When existing shareholders will come to A and convert warrant into equity, what will happen? A will issue equity shares, but are those numbers fixed today? Yes. Is the amount fixed today? Yes, both the amounts are fixed today. So that's why fixed for fixed criteria is met. Number one. We can also evaluate this under the criteria of derivative, because if you remember, financial liability definition has one component which covers derivative part. Remember, derivative instrument which will not be so and so, something like this we discussed. Let's evaluate that. Value of warrant changes in response to changes in the value of underlying. What is the underlying? Equity shares. There is no initial net investment for the warrants, and it shall be settled at a future date. So that means warrant meets the criteria of a derivative. Correct? So that means warrant is definitely a derivative. There's no doubt about it. A derivative contract. Now let's use the definition of financial liability. A derivative contract means warrant that will be settled by exchange of fixed number of equity shares for fixed amount of cash meets the definition of equity instrument. Correct? This is the definition of equity, sorry, not the financial liability. Yeah? The above contract is a derivative contract that will be settled by issue of fixed number of equity shares of own equity instruments by A Limited for fixed amount of cash, and hence it will meet the definition of equity instrument. All right, clear on this? Yeah. Why it should become equity? Okay. So now, before I move further on to other questions, and in the meantime, Kunal is also given the response. Kunal is saying, sir, there was no mandatory liability in the last illustration that we discussed. That's true. So there are certain loans which are in the nature of payable on demand, or you can say which are in the nature of receivable on demand. It's one and the same thing. Let's understand what do we mean by that. Say A has given loan to B. A has given a loan to B. There is no fixed period. This is something you will see very commonly. Many a times, when you will take, say for example, a telephone connection, what will happen? What will happen? You will take the connection and you will be required to give a deposit to the telephone company. Correct? So let's suppose you give a deposit. Now in this case, do you have a contract with the telephone company that I'll have your connection for 5 years, 6 years, 1 year, 6 months? No. There's no contract. There's no contract. Now in this case, couple of things are required to be understood. In fact, I'll just change this example. Instead of calling this as telephone deposit, I'll say many a times various customers are required to keep a deposit with the vendor company. So let's suppose A has a customer B and A is the vendor for B. Yeah. Now there's a term which says that new customers are required to keep a deposit with A. A Limited says that any new customer will be required to keep a deposit for dealing with the company. So what is it that the new customers have been doing? New customers deposit a certain amount with A. Okay. Now, this is again something which is very commonly done. And in this case, another very common point is that there's no fixed period between these two parties as to for how many number of years they will deal with each other. Okay, there's no fixed period which is involved. This period is something which will continue for 10 years, 15 years, 20 years, or maybe 1 year, or it could be only few months. But what is the arrangement between these two parties? They will enter into a contract, no doubt about it. When they will enter into a contract, so the contract will say that till the time B will trade with A, we will carry out business activities with B, this deposit will be kept with A, and when this contract will get over, or whenever the two parties don't want to carry on further in terms of these activities, then the deposit will be refunded by A to B. So in this case, B has given a deposit to A. Okay. Now in this case, I have few questions to start with. And I'll need quick responses, please, from all of you. In this case, can you tell me which party will become the holder and which party will become the issuer? I know this is a painful area for you or some of you even now. That's why it's very, very important for me to understand now which party will be considered to be holder and which party will be considered to be issuer in this case. Quickly, can you tell me who will be the holder and who will be the issuer? And as I told you, I need quick responses from all of you. Who will be the holder and who will be the issuer? Can you all quickly please let me know? I'm waiting for a response. Need your quick answer, please. Who will be the holder and who will be the issuer in this case? It's very, very easy. And I'm not sure why you are not answering this. Who will be the issuer and who will be the holder in this case? Okay, Kunal has answered this. Kunal is saying, sir, I think A is the holder. Excellent. What about others? You don't need to think about it. You need to be sure now because we have spent so much time on financial instruments. Challa is saying, sir, B is the holder. So I have received two different answers. Let me just see if anybody else also wants to answer this. Yes, quickly, please. Quickly. Who will be the holder and who will be the issuer? Because I think By now you should be knowing this. Tell me, who will be the holder? In this case, who will be the holder? B will be the holder. If you remember, I told you that holder will be the one who will hold. And when you hold something, what will it become? Will it become asset or a liability? It will become an asset. So that's why B has to be a holder. And that's why who will be the issuer? A will be the issuer. So for A, what will this deposit become? Financial liability. And for B, what will this deposit become? Financial asset. Yes or no? This is something with which we started. You remember we started with this, our discussion on financial instruments. And very surprising to know that you couldn't answer this. And that's why I'm telling you, all of our efforts will go wasted if you don't practice and if you don't revise. Okay. Now let me just come to the principle. Now in this case, whether it is financial asset or financial liability, the next question will be to check under what classification it will go. Means, can we say for B it's a financial asset under fair value through P&L, or can we say it's financial asset under fair value through OCI, or can we say it's a financial asset under amortized cost? And same goes with this financial liability, because there again two buckets are possible. So can you tell me under which bucket it will go for A and for B? Quickly. And I would say this is again very simple for you to answer. Kunal is saying, sir, I got confused. That's okay, but you are getting confused now. That means just think about the exam. What will happen? And this is natural. So you need not worry. But yes, this is sort of alert for you. That if you don't revise it now, after some time, your confusion will increase. And this is something which is not applying to you. It will apply to all of you. That's why, please remember my words. Now, can you please quickly tell me under which bucket this financial asset will go and under which bucket this financial liability will go? Quickly, I'm waiting for a response. Kunal is saying, sir, for B, that means financial asset will be amortized cost. Very good. What about others? And what about financial liability? So Kunal is saying, sir, this should go to amortized cost. Correct. What about financial liability, please? Under which bucket it should go? Challa is saying, sir, for B, holder, it should be fair value through OCI. Why? Do you see any sale of this deposit by B to any other party? No. So for fair value through OCI, what do you need? That the financial asset should also be sold along with hold to collect. Remember, so it cannot be fair value through OCI. It has to be amortized cost only. Now, can you tell me for financial liability, what should be the classification? Kunal is saying, sir, for A also, it should be amortized cost. Very good. Yeah. So it's good to understand that we could reach up to the point which is already covered by us. So up to this stage, whatever questions I've asked you, whatever discussion I've done, it's all conceptually clarified. We have discussed this. We have spent significant time on this. Now comes the point which I just wanted to cover today. And let's just think about financial asset only. Now, for this amortized cost accounting to be done, this deposit given by B to A will have to be computed at present value. Let's suppose B has given a deposit of 1 lakh. Now, what will be the requirement? The requirement will be to compute its fair value. On initial recognition, what do? We compute present value. Present value is nothing but the fair value. Yeah. And let's suppose this is the future date. This is the future date. From the future date, when this amount will be receivable, what do we need to do? We need to compute its present value on today's date. Chavi has also answered that, sir, these assets should be financial assets. Now, can you all just think about this situation that there is something known to you, wherein you are required to classify it at amortized cost, but now there's a practical problem in front of us. That for computing the present value, what do we need? Period. Because otherwise, how will you compute the present value? You need to be sure that what's the period. There has to be a fixed period for present value to be computed. In our case, do we have any fixed period? No. It can be 1 month, it can be 6 months, it can be 3 years, it can be 5 years, it can be 20 years. So what is the period that we take for the purposes of discounting in this case? Can we take any period? No. We don't have this period available to us. Period is missing. And it's not that information is not available. The terms are such that the period cannot be set. Can we build any expectation over here? When the period is not available, what can we do? We can say, no problem, sir. Let's understand that generally, what will be the period for which deposits will be kept? Can we build any such expectations? No. So that means now there is a big problem in front of us, that we are unable to compute the present value. Yes or no? Yeah, we are unable to compute the present value. So in this case, what will happen? Will we not compute the present value? And we will not do the amortized cost accounting? Does it mean that we need to go to some other bucket now? No. In this case, when you don't have the period available, so what will happen? This value in itself will become the present value. And let's understand the rationale. Why do we say so? See, these type of deposits are called as payable or receivable on demand. Means, let's suppose after entering into a contract, very next day, B cancels the contract. So what will happen? A will be required to pay back the deposit to B. So when is this payable? On the part of A, on demand by B. And something which is on demand means it can be, it would be required to be paid at any point of time. Correct? It may go to infinity, like Kunal mentioned, and it can be as small period as 1 day. That's why what will happen? For this, the present value will become the contractual value. Means the contractual value and this will be same. And you will be thinking, so that means will not be required to accrete interest, will not be required to book prepaid expense, etc. That complicated accounting will not be required to be done here. Yes. Yes. And you would be praying that please, sir, do something. That same question should come in our exam. It may come, but for small marks. But important thing is for you to remember the concept. You never know what may be asked in the exam or not, which may require some computation or more computation. Important thing is for you to understand the concept. Okay, these type of deposits or these type of instruments are called as on demand loan, on demand liability. Clear? Yeah. So have you understood how will you treat them? So they will continue to remain in the bucket in which they have, that is amortized cost. But when you will compute their present value, the present value will be equivalent to the contractual amount in those instruments. All right. Okay. Clear on this part? All of you? Now, same thing will apply to financial liability also. For financial assets, we understood that this is how it will be done. For financial liability, we will be required to do the same thing. We will be required to compute its present value. So, does it mean that for financial liability, once again, it will be something which in the nature of present value? Yes. And for which we cannot have any period defined? No. So that means for financial liability, once again, it will be equivalent to the contractual value. But in this case, one thing which you can just take note of, that B is the holder and B knows up to which point of time he wants to carry on with this and till which time he will not demand the money from A back. So if B expects that he will not do it for 2 years, then we can take a period of 2 years and compute the present value accordingly. So that's why from holder side, expectation can be set, but from issuer side, expectation cannot be set because issuer may be required to pay this back at any point of time. Okay, clear? All of you? Yeah? So with this, we are done with our discussion for today. And as we have discussed in the next session, we'll pick up 3 things: hedge accounting, computation of EIR, and of course, we'll practice the questions. Okay. And it will be very, very important for you to come after revision for practicing the questions. Yeah. And if you have any questions now, we can have a discussion on that. Otherwise, we can just conclude with our discussion. All right. Okay. So we can just end our discussion now. Any questions, any doubts in case you have? Thanks, Chavi. So Chavi is saying, I appreciate the way you teach financial instruments. The important thing is that at the end of the day, you should feel that conceptually you have understood the topic. And you should feel that the topic is not difficult. So if you have been able to feel that, then my objective is achieved. All right. Yeah. So thanks to all of you once again. We can just now conclude this session. And thanks to all of you for your participation. But I would want more participation from your side in the next session. And that is possible only when you will come after revision. All right. Yeah. Thanks to all of you.